Good afternoon. Welcome to the first Traphagen webcast or webinar. And in the future, we certainly hope to have more of these. Some will be pre-recorded, like this one. Some of them will be live. This one's topic, certainly should be no surprise, is in relation to COVID-19 pandemic and the impacts it has had on the market. What we're going to look at today really is a detailed look at the past 5 years and what's happened in terms of price returns over the global stock market in that time, and a much more detailed look at recent stock market reaction. And that's really just over the past couple months. We're going to look at how this is impacting different industries and sectors within the economy. And it's vastly different from industry to industry and sector to sector. We're going to look at how Traphagen's alternative investments have performed. This has been a great test for them to see how they held up. And then we're going to go to recent tactical trades we have made or tactical investments over the past couple months, despite this being a very bad situation, of course. Just like 0809, just like 2000 to 2002, the worst times present the best opportunities to purchase and to make money. And then lastly, we're going to go to an outlook for 2020 and looking ahead to 2021. So to begin, we will look at the last 5 years of stock price returns. So this graph goes back to April 2015, and it's through April 7th, I believe. And basically, this has been one of the most significant, one of the most abrupt and sudden crashes, if you want to call it that, in recent history. So the global stock market wiped out about 5 years, almost exactly 5 years of price gains in about 2 to 3 weeks. Really, we'd never seen anything quite like this before. And that was really a function of the stock market investors more or less ignoring the COVID-19 until it became painfully obvious all of a sudden, one weekend, really in March, when the NBA closed down. We started to get a rash of headlines, and that has caused this cascade downward that culminated about 3 weeks ago. And we've seen a significant rebound since, which we'll talk about. But that being said, it was just a tremendous amount of value lost in a very short amount of time. And this just gives you some aspect of, it took 5 years to build those price gains up in the global stock market and 3 or 4 weeks to wipe it out. But we're starting the rebuilding process as we speak. This is a much more detailed and short-term look at exactly what happened just in 2020. So starting January 1st through really middle of February, late February, we were quiet, very low volatility, and reaching new highs on the stock market. So we reached an all-time high of 33.91 on the S&P 500 just in February. In mid-February, basically everybody was ignoring COVID-19 as an economic threat to the U.S. and most other countries outside of China. And then again, once we started to realize this was coming to Europe, this was coming to Japan, South Korea, and ultimately the United States and becoming a global issue, some investors started to sell for fundamental reasons. And that's what you see in that blue tinted area where, investors are saying, okay, there's fundamental reasons where we should be selling. No real panic yet, but selling started just because they saw earnings were going to be lower in the future for corporations in 2020. Possibly chances of recessions in some countries, maybe not necessarily the US yet, but certainly a slowdown at least. And you had fundamental, but not panicky selling in late February and early March. Then what happened in mid-March to late March was really the panic episode, highlighted in that orange, light orange. And that's when there was a combination of still investors selling for fundamental reasons, but also we started to see forced liquidations of different pension funds, mutual funds, ETFs, closed-end funds. Some investors were just way overweight on risk assets, and they had to sell. There was downgrades of high-yield bonds to investment grade bonds to high-yield bonds, where there were forced sellers there in the credit markets. Got to the point where there was literal market dysfunction where the bond markets and the stock markets were not working correctly. And that's really where we saw 10% down days, the worst since 1987, and several of them. So this was the most panicky period, at least since the 08-09 crisis. And at the apex of that, which was in late March, we had a low about 35% from top to bottom in a matter of weeks. Never saw that before. And I'd also highlight that is the scariest time, of course. That is the most volatile time. But that is also the time when opportunities were at their height, where if you had the stomach and the analysis and the research to go through and look at some high quality companies in there. For instance, Coca-Cola was trading about 60, 65 before all this happened. Obviously, very defensive company, great company, well-managed company, good dividend. That went from 60, 65 to about 35 to 40 in a matter of weeks. Just one example of many, many opportunities in there. Another thing that was really unprecedented was the bond market. Within that panic crisis period, we saw the bond market really start to dysfunction, where we could buy ETFs or funds of bonds for roughly 5 to 15% less than the actual value. So there was arbitrage to be had as long as you had the cash to work with and the research. That's where the most opportunity really came from. And that's where we made tactical trades, which we'll get into in a second. And then once you start to get into April, really we saw a pretty significant, and that continues as we speak today, rebound. So this says about 20% gain. Really after today, we're probably in the low to mid 20% in terms of a gain off the very bottom. And this was a function of a couple things. One, just a recognition of deeply oversold conditions. It's a rubber band. If you stretch it that much down, it's going to bounce back. So some of it was technical, just buying the dip. But another piece of this too is, especially lately, we have seen some improvement in terms of the health side of this thing. So, the curves are starting to flatten. The most heavily hit areas, New Jersey, New York, especially New York, seeing some encouraging signs lately. And we're getting better ultimate forecast for the entire country in terms of cases and deaths. So that really, over the last week, was another leg up in the recovery. And, from here going forward, it's really going to be a matter of any medical advances return to normalcy. So this is a grid that we produced saying this is, to borrow Chuck Carnival's phrase, it's not really a stock market. It's a market of stocks. So there's, different companies and different stocks and different industries react very differently to different things. So this is a grid we put together by time frame of looking at all or many different sectors and industries within the stock market and our estimate of how they will be impacted in the short term, the intermediate term, and the long term. So when you look at this, pretty obvious. Verizon, communication companies, a lot of healthcare, pharmaceutical companies, grocery stores, staple companies. Really, those are not impacted at all, and in some cases actually benefit from this. So those are those green colors, and we continue to think those sectors or industries could still be volatile, but ultimately will benefit or very minimal impact, and that'll continue through. So those are relatively safe places to be. Even when you go down a little bit, most technology, especially non-ad based, communication-based data center real estate, cell phone towers, things like that. Again, that's either a beneficiary or no real impact from this. And those we've added to. And then you start to go down. Utilities, they're defensive. We like them. We bought them. They might have a little bit of a short-term negative impact as people use less electricity, less people in the offices. But we think that will gradually come back and still be pretty resilient. And then you get down to what we have seen over the past month or two. All these sectors, especially towards the bottom, have been severely impacted. So banks, insurance, a lot of energy, restaurants, any physical entertainment, malls, retail, commercial real estate. And then you get to the worst, the epicenter of it would be the travel, tourist industries, airlines, and cruise lines. And we think the impact on airlines, cruise lines, travel, malls, some real estate, and some restaurants, we've avoided those, and that could really last for quite some time, the impact on that. And basically, our job is, to look for the companies and the industries and the sectors that have been dragged down with the rest of the stock market. So even in the sectors and industries that we think are neutral or slightly positive impacted by this, they're still down at the lows between anywhere 20%, 30%, maybe 40%. And it's our job to find those that have been dragged down, but still have a long-term future ahead of them. And that's the tactical trades and investments we've been making. Now, in terms of, we've been in alternative and private investments for years now, basically waiting for a moment like this. And this has been a great test. This is about as abrupt and severe downturn or crash, along with a recession, that you could see or that we have seen recently. And in that time, the alternative investments really have held up probably even better than we would have thought. So the first two are the pure private investments. And again, those are only available to 1 million plus clients. And the stars do represent, these are estimates, pretty confident that they'll be right around there, but they can be a little different in talking with both companies. But GPB2, up about 2.5% of that. And part of that's coming out with a dividend this quarter. So they did announce a 6.5 to 7% dividend. So part of that return is from that. Mosaic continues to act extremely well, and we expect about a 1.5 to 2% return in Q1 2020, really with limited to no impact from COVID. Insurance-linked securities, just by their nature, they're really only impacted by earthquakes, hurricanes, and they were none, in the first quarter. So those have performed well. Private real estate. That's interesting, where our private real estate holding is up 0.9% on the year. Publicly traded real estates, or REITs, they were down as much as 30% on the year. So really a huge difference. And because of that, we're looking to, and we have already, we've taken a position in public real estate for the first time in years after valuations had improved. And it might be time to trim some out of the private real estate, which has held up incredibly well, and then put more into public real estate, which is at more of a discount now. Alternative lending, that is held in there very well. Not up, but still, compared to all other classes, being down 1.4%, pleased with. The real assets, which is private infrastructure, timberland, and farmland, that, again, is going to be a little more tied to the overall stock markets because it does have a public sleeve in there. So most of that fund is private, but some of it is publicly traded. So that public piece brought it down somewhat, but still being down 5.4 when you compare it to down between 15 and 20% on the S&P 500 and the ACWI. Really, we are pleased with. And for most clients, it'll vary from client by client. But in general, the overall returns on this alternative space have been completely unaffected by COVID-19 on average, and basically break even for the year. So we are very pleased with that. And as that lower line, that emboldened line says, this is tremendous value. It allows, obviously, protection of principal, significant rebalancing opportunities. So now we could sell out of some of these things that held their value, go back into public things. And in the same time, we were holding these that had long-term returns significantly higher than bonds. And we're going to use these to add to some tactical positions in the near future, probably over the next month or so. And these are examples of tactical trades we have made in almost all client portfolios over the past month. So it basically goes through each one and the returns that we have gotten. Really, these returns we have gotten in the past 3 weeks or so. So these are really, incredible returns over the time period. So our first was in addition to large cap technology. We already had a position here, but we have added to it. And really, this is a story of strong balance sheets, strong growth, and frankly, limited or even benefit from COVID-19 impacts. So this would be Apple, Google, Microsoft, Amazon, Netflix. And really, you look at Amazon's a perfect example. They are up on the year because obviously e-commerce, with everybody getting shipments from home, is going gangbusters. So the combination of all that has led us to increase our exposure to large cap technology stocks. and we are up about 9 or 10%, depending on client, on that position. The biggest return we have had, oddly, is on the bond market. So we've already had, for most clients, some allocation to high yield debt, but we increased that in about 3 weeks ago. And here it was a story of market dysfunction, market dislocations. So we could buy a fund of bonds that was trading about 10% lower than the actual value. And in addition to that, it was yielding at the time maybe 8, 9%. In addition to that, the spreads between those yields and treasuries were very large, spreads or dislocations. So we bought ANGL as the ticker on that one, and we are up in about 3 weeks, 26 to 28% on that trade. So obviously very happy there. Public real estate, again, as I was saying, been absent of that. We thought it was expensive for years. We finally purchased it about a week and a half ago. And again, cheapest valuations in the sector since 2011, 4.5% dividend yield. And this is not a pure play, but a large play on cell towers, data centers, residential, multifamily, distribution warehouse centers used by e-commerce. There is still some retail and commercial in there, but is a lower percentage. And as of today, we're up between 13 and 14% on that position for most clients. Utility companies, again, we thought these were expensive for the last couple of years. So these now, when we bought, we're at the cheapest valuation since 2016. Has a 4% dividend yield. Defensive cash flows up about 14 to 15% there. Natural gas, oil pipelines are interesting. So with oil crashing from 60 to currently we're at about 29, 28 bucks a barrel. And that, as we speak, there might be some deal actually reached between the Saudis and the Russians on vastly limiting supply. So that would be bullish for oil and the sector. But these are the cheapest valuations we've seen in more than 10 years. Currently, as we sit, it's about a 7.5% dividend alone and fairly defensive cash flows. These guys, they store oil, they transport it, but they do not extract it. So they are fairly indifferent to the price of oil. They just care if they store it or transport it. And we're up, not as much as the others, but up 5.5 to 6.5% on that position. And I would say on the last three, the real estate, the utilities, and the pipelines, these are dividend plays. And as you can see, 4 to 7.5% dividends compared to a current 10-year treasury yield of 0.7% is just incredibly attractive, or compared to 0% on cash. So we really think there's going to be a strong demand for dividend yield going forward, and we sort of wanted to front run that demand, and it's paying off already. And then lastly, on the tax-free side, HYMB, this is high-yield municipal bonds. Again, there was a discount there, so we wanted to take advantage of that, along at the time with a 6% tax-free yield, which, if you're in any type of tax bracket, that could be equatable to, 10, 11% or so, something like that. And we're up about 6.5 or 7% on that trade. So far, we really like the tactical trades we put in for almost all clients. Significant profits really in the course of 3 weeks. And again, these were done in that panic period. Even though that's the scariest time, the most volatile time, that is when the money is made. And then, looking ahead and where we are now really for 2020 and 2021, certainly we're in a recession. I don't think there's any debate about that. And it is likely to be quite deep. So for Q1, we probably went down in the mid-single digits in terms of GDP growth. Q2 will be very poor numbers. So, just get ready for that. The estimates range from anywhere down 10 to down 30. So it will be deep. If you shut the economy off, it's going to be a deep loss of economic growth, no question. But on the plus side, that was voluntarily and fairly short in duration. So we do think there'll be a Q4 2020 and a Q1 2021 type of recovery. Again, 2020, very depressed corporate earnings. Estimates, again, are all over the place. It would not surprise us to see earnings decline by anywhere from 20% to 50% from 2019 levels. But again, that should be isolated to 2020. And the stock market's beginning to look ahead to more normalized earnings in 2021. We do believe the worst of the health and the closure shutdown headlines are basically happening now or behind us, which is good. And we think that's why the market has recovered significantly off the lows. Still going to be bad. You're still going to see negative headlines, but we think progressively less and less negative, and then eventually turning to positive. Again, once you see the headline of baseball reopening in some sort, or restaurants in your town being able to operate again, hair salons, things like that, that will be certainly a positive. And that's coming. We don't know exactly when. Maybe a month, maybe 2 months, but it is coming. And then from this point forward, really, market returns are going to be based on corporate earnings. When we start to get those in about a week and a half, we'll start to get some corporate earnings and their forecasts. Pace of return of normalcy. So once we get a better idea, and it seems to be sort of coalescing around sometime in May or June when we'll start to gradually get back to normal. It won't be back to 100% by any stretch of the imagination, but it'll be better than where we are now, put it that way. And any medical advances. So if we start to see certain medicines or therapeutics start to work and really be able to help people and avoid an ICU or a ventilator, that would be huge news. And obviously, the big one would be a vaccine, even though that's most likely 12 to 18 months. And then last couple slides are basically just to show, even though like all recessions and all market drawdowns, this has been extremely scary, extremely abrupt, violent, and it's been unique in the sense it's also attacking from many sides: financial piece, personal work piece, small business piece, health piece, everyday life piece. But that being said, this graph basically shows you the relative severity or occurrences of bear markets or drawdowns versus bull. And if you're in there trying to time bull markets and bear markets by essentially trying to capture all the bulls and avoid the bears, it's, you're really rolling the dice on that one. And from all our studies and all our research, personally with in-house clients and just more general research from third parties, trying to time those downturns is really one of the most detrimental actions a long-term investor can take. And that really gets us to the next slide, which, missing the best days in the stock market is really killer. And some of these numbers are frankly stunning, where if you were just in the stock market, and this is taking the 2-decade period from 1995 to 2015, but it's true across any really 20-year period to differing degrees. If you were just invested $10,000 and did nothing over that period, you would have gotten a 9.9% annualized return. But if you attempted to time the market by selling out at certain points when things look the worst and saying, okay, I'm going to get out now, but when things look better, I'm going to get back in. And let's say you missed only 30 days. Let's say you just missed the best 30 days out of 20 years, which is nothing in terms of the amount of days. That 9.9% return turned into a 1.5% return. And that's why, paradoxically, it's really much, much more dangerous to try to avoid downturns than it is to just stick with the long-term plan that you and your Traphagen advisor put in place. And that's what we really try to emphasize, because missing, 30, 20, even 10 days could be significantly detrimental to your retirement. Where if you just stay in, you do nothing, or you rebalance, which we do for you, of course, you really avoid that risk. And that really wraps the webcast up. I just want to thank everybody for joining us and taking the time. And if you have any questions on anything in the presentation, you could either contact your Traphagen advisor or myself at eric@tfgllc.com. Thanks a lot. Stay safe.